Legend of the ETFs and REITs. Yeah, it's out there. A leverage ETF, you have a couple, a leverage and a short ETF. They're unusual. The leverage ETF uses debt and overweighing, sometimes they call overweighing, overriding. And what you're doing is you're putting it out there trying to sell an option and hope that people never pick it up. They call that overweighing. So, or derivatives to magnify the returns on the index. The goal is to try to sit down there and, of course, improve your overall return on the value. So people play games with it in the process, hoping somebody doesn't pick it up. Or you can actually short an ETF, and there are ETFs designed just for that period. So you're making the bet that this group of stocks or bonds in the process will be shrinking in value overall, and then you cash it, make an awful lot of money. So, and then of course you go out and you spread the rumors about people, this company's a bad company. You say bad things about them, which is kind of like contrary to, well, it's investment. Anyway, so you have a short ETF or a leverage one. Closed-end funds, they're bought and sold in the security markets like ETFs, but they're mutual funds. So you have a number of shares that won't change, and the level of the debt is preset beforehand. So you're paying attention to this. It's closed end, so you really focus in on that. It really is a closed number of shares that can trade at a discount or premium because they're not just multiplying the shares as they go through. It's only this number of shares is the only amount that we'll ever publish. So you have that going. So on the closed-end mutual funds, a lot of them, they earn dividends, especially large dividends, and the interest earned, and often you can plow it back into the overall value and increase the amount of the value of the stocks that you have or the shares that you have within that mutual fund. So you have that one. The ultimate one out there is the hedge fund, and the hedge fund are people that really have a lot of wealth. So that being said, you have to have about $1 million just to start, or for one of the hedge fund managers to pay attention to you as an individual, because they are high-risk funds a lot of times. And really, if you follow the intelligent investor's advice, you only have 10% of your money into bad money. Hedge funds are mad money. It's usually high risk in the process. And so you'll see different aspects of it. They'll have risky investments that are not allowed usually with anything mutual fund. And sometimes they'll put all in a company. It just depends what the manager's doing. And a lot of times the managers are some of the most brilliant people on Wall Street. They have a fee of about 2%, which is kind of high. And they have a 20% incentive to sit down there and bring back that high return. A lot of times, investors, as soon as you put the money in, you can't redeem them for a set period of time, and there's no secondary market out there. So it's just you and that person working that hand in hand, and also the whole cluster that they have in that hedge fund. Private equity firms, they go into a company and they aggressively cut costs. They make it profitable and they quickly sell it or make a new company and they have an IPO with it. They do a lot of different things. I was involved in one of these in the aspect of they were trying to hire somebody in human resources, but the person's job was going to go through and look on the different clinics, and they bought another clinic, and they were competing in the same market, and the person's job was going to be around to tell people, we're going to close your clinic because you're competing against this one, and now they're both. I was going to be the one to lay people off. That's not my fun job, so I declined the job. But that was a result of a private equity firm where they go out, they buy something, they reduce costs drastically, they sell it, and they move on. And there's little caring for anything else other than profit, which I guess is what you're after with a private equity firm. You have a real estate investment trust. Really, I have to tell you, this is very attractive. It's stable. It's different than a stock or bond because it's real. It's a real asset. It's in property. So you'll see them traded on the New York Stock Exchange. A lot of times you'll see them traded out there. And so like there'll be an apartment complex and a company goes and buys them and then they sell portions of it out there. It's kind of a fun thing because you're actually owning property. And so it depends on the value and the people that are involved with it. So it's very interesting. It owns real estate and it lends money to owners and developers for that with the mortgage RET. So then you have a hybrid between the two. I think it's a fascinating aspect. I've considered dabbling in it myself because I think it's a good, solid thing because it focuses on real assets instead of paper assets between the two. You'll see the impact of the real estate market, though. Really, even no matter what happens, real estate tends to always be stable, except recently you'll see some major downturns primarily because of interest rates, but also some of your urban areas have problems because of some of the difficulties they have after the pandemic. They never seem to have recovered. So you see a property that's being sold for a fraction of the price. So this is now a dangerous area because of the fact you have some huge changes. You can see the drops there from 2020 on. So you have problems with this aspect, but usually a real estate bubble actually continues nonstop. We'll see what happens in the next 5 to 10 years on this aspect. You can invest in it. You can invest in stock and companies, heavily invested in real estate. Okay, you can also have a real estate focused ETF, a real estate focused mutual fund. Either way, this is usually a smart investment because it's dealing with real assets that are physical assets rather than paper assets. So it depends what you're doing. ETFs, leverage and short versions, they're very interesting. Hedge funds, higher risk, higher rewards, higher fees. Okay, and then real property investments, the REITs funds, they really are interesting because you're investing in a more stable currency, except maybe not at the moment. This depends what the market is, and you always got to watch it because investments, too often, there is a winner and there's a loser. You don't want to be this one over here. You want to be this one over here in the process. Take care.